Uh-oh. The USA, big problem. That America just dropped the ball. The world's biggest economy just lost its AAA credit rating. Its last AAA credit rating. Two other agencies already downgraded it. Some people are losing their brains over this. Oh my gosh, everything to zero. But is this the spark that tips us into the next market crash, next recession, big bear stuff, whatever? Or is there more to the story? Not really that much to worry about. Stick around as we dive into this downgrade, what it actually means, why it's got markets buzzing, and how it could, of course, most importantly, impact you and your portfolio. So what exactly happened? Moody's, the final holdout among the big three credit rating agencies, just slapped a downgrade sticker on Uncle Sam's credit report. Naturally, people on Wall Street are clutching their pearls. Oh no, how could you do such a thing? Others, getting the popcorn ready. Watch the chaos unfold. Think of it kind of like this. A AAA credit rating is what you'd expect from someone who, well, always pays the bills on time and never forgets their wallet at dinner. It's the gold standard of international creditworthiness, like a financial clean bill of health. So why do we care that Moody's is throwing shade at the United States? Well, credit ratings are basically report cards for countries and companies. They tell investors, hey, just how risky is it to lend money to these guys? The higher the rating, the more trustworthy the borrower. The lower the rating, well, investors start to raise eyebrows and should therefore expect higher returns, aka higher interest rates on government debt for that higher risk. Now, when it comes to these report cards, there are three big teachers in the room, let's say. You have Moody's, S&P Global, and Fitch Ratings. These agencies assess how likely a borrower, like the United States government, is to pay back its debts in the future. They use letter grades ranging from AAA, which is the gold star, aka teacher's pet, all the way down to D, which is basically, kids who didn't even show up to class. Countries like Afghanistan probably have a D rating. Moody's just downgraded the US from a perfect AAA to a slightly less perfect AA1. Is really not a big deal, to be honest. But why'd they do this? Well, in short, debt and dysfunction. Moody's cited the U.S.'s ballooning debt burden, now sitting at $36.8 trillion, the ongoing political gridlock in Washington, basically meaning it's impossible to address this debt issue and the deficits. The debt now equals more than 122% of the country's GDP, meaning the U.S. owes significantly more than it produces in an entire year. Even more concerning, interest payments on that debt now exceed the annual defense budget. It's one of the biggest line items in terms of expenses for the USA, a very big red flag for the credit agencies, because it means more cash is going to interest than to actual services or innovation, things you probably would like to see your money spent on, like Department of Education. I guess they scrapped that, didn't they? But you know what I mean, schools and roads and all that bullshit. Now just gone, interest on debt. But here's the deeper backstory. Moody's warned that federal deficits are expected to significantly rise over the next decade, driven by three key things. Rising entitlement costs, so Social Security, Medicare, stuff like that. Higher interest payments on the debt itself, and insufficient tax revenue to offset the spending. They're projecting the deficit will grow from 6.4% of GDP in 2024 to nearly 9% by 2035. That's crazy, man. That's definitely not sustainable. And it doesn't help that lawmakers are still debating whether to extend the Trump-era 2017 tax cuts, which Moody's said could add another $4 trillion to the deficit over the next 10 years. And Trump's proposing more tax cuts. Basically, the United States is spending like a college student with a credit card and no job. Good thing is that the United States creates the world money, so it's like a college student with a credit card and no job that has an infinite credit card, basically. Moody's decided it's time to stop pretending that everything is fine. They called bullshit on America's current financial health. Now, before we get into what's really the uncharted territory of this crazy story, guys, if you're trading these cryptocurrency markets, I know you are. You're trading that Bitcoin. You're trading that Solana. You're probably even trading some dog coins. You want a great place to do it at? It's called BitUnix. Best place to be trading crypto these days. I'm doing most of my trading over there. No KYC, no VPN, just deposit your USDT, trade available to anyone, anywhere in the world. And here's the deal. Right now, limited time offer, you get $10 for starting your account, $400 in deposit bonus. So you deposit, that's up to 20% basically. You deposit $1,000 to get $200 back. You deposit $2,000 to get $400 back into your account. It's crazy, man. And up to $2,000 in trading bonuses, which is also pretty gosh darn crazy. Check it out. Link down below. If you're trading the cryptocurrency markets, you need to get an exchange that meets you where you are. That's BitUnix. Link down below. Go check it out. Okay, so let's get back into this very crazy topic here. Here's the kicker and all this stuff. Credit ratings downgrade for America is not uncharted territory. The S&P already downgraded the U.S. back in 2011. The Fitch guys followed suit in 2023. So Moody's is actually just the last holdout. And they're saying, finally, that's it. Bullshit on America's economic health. Say enough's enough. Now the U.S. has officially lost its last AAA badge. What's it actually mean for markets besides Wall Street pearl clutching? Well, in the short term, there might be a little bit of turbulence. Investors tend to react to headlines before reading the fine print. Stocks maybe are going to wobble a bit. Bond yields could spike a little bit. Financial commentators will be out here screaming recession, double top. That was the bear market rally. It's all going to zero. Zero. They do every single day. This downgrade, though, it's really more optics than apocalypse. I mean, come on. Remember, the U.S. has already been downgraded before. S&P did it in 2011, Fitch in 2023, Moody's catching up to the party in 2025. Despite those cuts, the U.S. economy went on to hit multiple new highs. The stock markets reached insane highs from the time of those cuts. The dollar didn't exactly collapse into a flaming pile of IOUs. It's all a bit dramatic. And again, a cutting from AAA to AA1 is a joke. It's barely anything. In fact, U.S. Treasuries, the very thing that just got downgraded, are still seen as one of the safest places in the world to park money during global uncertainty. Here's where it gets interesting, though. Now that Treasuries are technically a little riskier on paper, even if like by 1%, they may offer higher interest rates to attract investors. And who pays those higher rates? The U.S. government, which unlike most borrowers can literally just print its own money to cover its debts, which brings us to inflation. More debt plus higher interest equals more money printing. That means more inflation. And of course, if they have to, God forbid, that the Fed actually raises the interest rates, that makes more debt problems, makes all this stuff that these ratings agencies are complaining about even more likely to happen. But here's where it gets more complex. The Federal Reserve has been quietly increasing its holdings of U.S. government debt. This move suggests the Fed is stepping in to absorb some of the debt that's issued out by the U.S. Treasury. Now, this action can actually be seen as something of a form of quantitative easing without actually being QE, where the central bank injects liquidity into the economy by purchasing government securities, albeit kind of in stealth mode. The concern here is that all of this additional liquidity could lead to inflationary pressures, which is bad news bears, and may force the Fed to hike interest rates again, which would be not good, especially when combined with the existing high levels of national debt. And when inflation rises, traditional currencies lose their purchasing power, but that's exactly where something like Bitcoin may actually shine. And for assets like Bitcoin, none of this stuff is a bug, it's a feature. So, got yourself some Bitcoin? Yeah. So look, markets are jittery, headlines are dramatic, but is this really a sign of doom and gloom? Depends on who you're asking, of course. There's always people who are going to say the sky is falling. Yes, it is not fantastic, and there may, again, be some turbulence, but headwinds in the market in the coming days. But it's not the end of the world either, not even close. If you think about it, it might actually do some good in a weird way. Here's why. If U.S. debt keeps climbing and deficits widen, then the government, what are they going to do? What is their option? Print more money. Now, money printing does equate to more inflation, but not immediately. The money needs to make its way through the system first. During that time, assets pump. Things like Bitcoin, dog coins, they pump. Obviously, thriving in an inflationary environment, Bitcoin's there. Hard-capped, decentralized, immune to the Fed's money printer. Bitcoin tends to shine when trust in fiat wobbles. A weaker dollar or a falling DXY index is usually the rocket fuel for BTC, and it has been falling recently. However, don't count the U.S. out just yet. Aside from the fact the U.S. didn't crash and burn even after losing its AAA ratings from S&P and Fitch, okay? Trump might also have made sure that the U.S. and the dollar will retain their dominance. You see, he's secured trillions of dollars of deals in the past week with the UAE, Saudi Arabia, Qatar, as well as trying to push stablecoins forward, which would increase the dominance of the U.S. dollar, all these kind of stuff, right? Maybe we're looking at a petrodollar 2.0 sort of accord. And if all this happens, it's not just a big win for U.S. influence, it's a big win for the U.S. dollar, and of course a big blow for alternative models like the BRICS nations trying to move away from a dollar-based system. So some will say the sky is falling, but if you zoom out, this downgrade's mostly a nothing burger. Sure, it might scare a few investors in the short term and a few people who just read the headlines and think everything's terrible all the time, but the truth is the U.S. is still the world's largest economy, the most dynamic economy, and the saying, don't bet against the USA, still rings true. And the US dollar is still the global reserve currency by a wide margin. And I know perhaps a bit of red in the market might make some people a bit nervous. I get it. But it's all good. It's all part of the process. If the US dollar does take a hit, guess what? Bitcoin benefits. They tend to move in opposite directions. So weakness in the dollar often means strength in Bitcoin. Now, massive dysfunction in the bond markets and stuff, probably not good for risk assets overall. But the Fed has a lot of levers they can pull, and so does the U.S. Treasury. Now, Trump's openly trying to make the U.S., of course, the crypto capital of the world, and his family's already knee-deep in the space in a whole variety of interesting ways. They're going to push crypto, guys. They're going to push Bitcoin. So whether you're bullish or bearish short-term, Bitcoin is going to win either way, medium and long-term. Don't bet against it. Don't bet against America. Don't bet against Bitcoin. And together, don't bet against those guys. Thanks for watching.